Good afternoon, everyone. We're so glad to have you all here. I'm Lynn Staggs. I'm the marketing senior for Stoner Dolphin Henry. So we're glad that you're here and that we have such a big, full room today. That's exciting. Just wanted to go over a few things with you. You've been given a folder. Inside that folder is a printout of the slideshow that we're going to be going through so that you can make notes throughout that. There's a handout in the middle of the table that he will be touching base on about some details on that. Pardon? Okay. And then also in the back of your folder is a purple colored sheet. So at the end of the hour, if you don't mind filling that out, so it can kind of give us some guidance on what we can do to do these seminars a little bit better or give you more information that's more viable for you. Also, this door over here is to the restrooms. Welcome to get up, get more drinks during the process. Ask questions during the slideshow, during the presentation, because we want to be able to answer all your questions for you as much as possible. So also, we are recording this seminar today. It will be posted on our website and our YouTube channel. So you will see several people standing around the room with microphones. So if you have a question during the process, if you wouldn't mind raising your hand and we'll scurry over to you with the microphone, because we want to be able to get your question on the recording also. So it'll help those that are going on our website and stuff to be able to hear the questions. So Mike Henley is going to be doing our presentation. He is our tax manager for the office. And before we get started with him, though, we would like to ask Steve Springer if he would say grace over our food for us. Even though we've eaten, God will forgive us after the fact.
Okay. All right. If we had known that you all love taxes so much, we would have done this sooner, you know. Actually, our firm has presented this seminar more than a dozen times this year already for various groups, but we're glad to do one that's open to the our entire client base here today. And so many of you came out. We really appreciate you being with us. I just want to make one comment, totally off the subject, before we get started. I'm at that age in life where I go to a lot of funerals. Some of you can kind of nod heads and you understand what I'm talking about. And it's been so interesting for the last week, has it not, how our public discourse has been a little more civil, a little more respectful, a little more, I don't know what the word might be. You get what I'm talking about. Patriotic. Thank you. As you pray over the weeks ahead, would you just pray like I do that our country would just continue that? I'm tired of all the fighting and all that sort of thing. So I'm sorry for the Bush family, but I'm thankful for our country to have this time where we can just be a little more civil, aren't you? Let's bow and pray. Heavenly Father, we thank you for the gift of life and health and for all the ways that you've blessed each one of us in this room this year. We thank you for the opportunity to gather together, the freedom that we enjoy. We thank you for our men and women in the armed services around the world who stand ready to protect us today. We pray your protection over them. And Father, we thank you for the food that we've enjoyed. We pray that you would help us to gain knowledge here today that we can use to better ourselves and to help others. And we ask all these things in the name of Jesus. Amen.
Thanks, Steve. Wow. We thought we were the only ones that got excited about taxes. So we really appreciate everyone coming out and sharing this event with us. I've not only been tasked to lead the presentation, but I also have to hold this mic in my hand. So my coworkers are already betting on how many times I'm going to drop it. So they don't realize that, being an ex-military man, we used to have to dummy cord everything to us. So if we dropped it, then, it's not going to go very far and stuff, and we're not going to lose and stuff. So again, welcome. welcome. And our intent and our goal today is to share with you some tax law changes, which are pretty significant that you will see, and probably the most significant in the last 30 years. And if you can take one or two of these things that we present today, and if that can save you some taxes or save a family member some tax, or even possibly defer paying that tax into next year or years down the road, then I think it will be a time worthwhile or well spent. So you should have a handout that you can follow along, and also the presentation will be on the multiple screens as well. Again, this is the tax update 2018. Most of these changes came about under the TCJA, the Tax Cut Job Acts of 2017. I think it was passed around December 17th of 2017. So, and most of these are effective for 2018. Again, probably the most significant tax act since 1986, about 30-something years, affects individuals, businesses as well. Has anybody took a look at the new 1040 tax return? We'll start with that. Significant changes there. It's still 2 pages. The pages are a little bit smaller, a postcard. But then in addition to the 2-page 1040, we've got 6 additional schedules that feed into that 1040, along with all the other schedules, A, B, C, D, E, and so on and so on. So, but again, some of those schedules that feed in, you may or may not have to fill those out and stuff. So supposedly it's going to be a lot better form. We'll see. We'll start with the tax rates for and of course the single rates. There's 2017 rates, what it was in 2017. Notice we've got a 15%, a 25%, and a 39.6. Moving on to those rates for 2018, you can see that those rates are gone. The 15, the 25, and then 39.6. And now we've got a couple new rates, the 12% rate, the 22% rate, as well as a 24% rate, and the 39.6 has been replaced with a 37% rate. That's the highest rate. Can everyone hear me okay in the back? Okay. That's the tax rates there for married filing joint 2017, and then you can see the difference there for 2018. Everyone's probably familiar with the marriage penalty. That's almost been eliminated. If you go down to the 35% bracket, that's where it sort of kicks in there, because under the single rate, it was $200,000 to $500,000, I think, and then the 37% bracket for a single started at, I think it was $400,000, if I'm not mistaken. So really, you don't run into that marriage penalty until you get to the 35, 37% brackets. The capital gain rates stayed the same. As far as long-term capital gain rates are 0%, 15, 20%, and then if you are subject to the additional Medicare tax, then they could go up to 23.8%. But they sort of maintain the old rates. I think if you were in a 15% bracket prior years, then you may not have to pay any capital gains at all at 0, and that probably would probably be kind of close to the 12% bracket there for married filing joint. Once you get above this year, say 77,400, then you will be subject to the long-term capital gain rates. Any questions on the rates, the new rates? That was probably one of the bigger changes for individuals, and I think as we move on, there's a few examples that we have that you'll see that you're actually going to save a little bit money of taxes just in those changes in the tax rates. The personal exemption that we're all familiar with has been eliminated. You can see what it was for 2017, 2018. It goes to 0. So Alimony payments, 2017, 2018, if it was qualified alimony, certain requirements enabled to, as far as it to be alimony, and it was deductible by the payer, and then the recipient had to pick it up as income. In 2019, that goes away. No longer deductible if you pay it, and no longer includable in income. So a big change there. The IRA contributions, you can see what it was 2017, 2018. This wasn't really impacted by the Tax Cuts Job Act or the TCJA, but just wanted to show you as far as what the index is from 2018 to 2019. And you can see that it increased about $500, I think, from 18 to 19. The catch up for a taxpayer that's 50 or older is still the same at $1,000. This applies to traditional IRAs, non-deductible IRAs, as well as Roth IRAs. And there's also income thresholds as far as the deductible IRAs as well as the Roth IRAs. A big change as far as IRA recharacterizations. In prior years, if you converted a traditional IRA, and let's say that amount was $10,000, and you could actually recharacterize that if you converted from a traditional IRA to a Roth IRA, and let's say the value of it dropped from $10,000 to say $5,000, and then once you met with your accountant or whatever, and they ask you the question, hey, what's the value of this account? Well, if it had significantly dropped, then you had the option, you could recharacterize that back to a traditional IRA, so therefore you wasn't paying taxes on something that had dropped in value and stuff. Well, after 2018, I think October 15th of 2018 was the last time limit to recharacterize something. So after that point going forward, if you do convert from a traditional to a Roth, no matter what the value does, you can't go back and recharacterize it. So 401k, 403 deferrals, not really changed by the TCJA, but you can see what the index is for 2019. Actually went up a little bit. The catch-up contribution stayed the same, right at 6,000. If you're eligible for a simple, 2017, 2018, it was at 12.5. The catch-up was at 3. And then the 2019's been indexed to 13,000. For a SEP IRA, if you can contribute to a SEP IRA, it's $55,000 for 2018. That's the max, and then 2019 indexed to $56,000. Qualified moving expenses, a change there. It used to be deducted as a front page adjustment to income, so you could actually deduct it if it was qualified moving expenses. That has been eliminated except for military personnel. For unqualified moving expenses, if they're not reimbursed for it, then they can still deduct that on the front page as an adjustment to their income. Not really any changes as far as the student loan interest deduction, still deductible. You can see the phase outs there, indexed a little bit for 2018. There was a change as far as discharge of student loan indebtedness. It has to be a certain type of student loan, but the change was that it could also be discharged for if the student became disabled or if they had passed. This is something that has been eliminated as well. It's the old domestic production deduction. Anybody familiar with that? Been around for been around for a while, and when it first came out, it was equal to about a 3% deduction. Then it went to 6%, and then it went to 9%, and that has been eliminated. But there's something that comes in later on that we'll talk about that sort of replaces that. So, but that has been repealed. A big change, really big change as far as the standard deduction goes, pretty much doubled from 2017. You can see it there, what it is for 2018, indexed a little bit for 2019. If you look at 17 compared to 18 for single, married, filing joint, it pretty much doubled. And we'll talk a little bit more about that here in a minute as well. Standard mileage rates, that's what it is for 2018. I looked earlier to see if the 2019 rates have been released yet, and as of right now, they have not been released. So, but I was reading, it may, as far as business, it may jump to 55.5 from what I was reading. So. Big change as far as deducting medical expenses. Of course, medical expenses are deducted as an itemized deduction. 2017, 2018, they're limited to 7.5% of your adjusted gross income. In 2019, it jumps to 10%. So if your adjusted gross income in 2018, for an example, is $100,000, then before you get any benefit at all from medical expenses as an itemized deduction, it would have to be over $7,500. So sort of take a haircut there. A big change as far as state and local taxes. Again, another itemized deduction, but the limit for 2018 is $10,000, and that includes income tax, state income tax, real estate tax, as well as sales tax. And one thing, as far as a planning tip that you might consider there, if you're paying, say, county taxes and your city tax, and then if you've been getting, say, in the neighborhood of a $3,000 sales tax deduction in Tennessee, because we don't have an income tax per se, we do have the hall income tax. But if you bought a new vehicle, in 2018, then you can take that additional sales tax and add that to that. Well, if that throws you over the $10,000 limit, then one thing that you could consider is maybe pushing your city taxes or the county taxes or one of those into the next year, where you could pay two of those in 1 year, kind of double up, and then you wouldn't lose any of that deduction and stuff. So, and speaking of the state tax, as far as Tennessee goes, yeah, we don't have a state income tax. We do have what's called the hall income tax, which is on dividends and investment interests or investment income, those kind of things. And that's down to 3%. This year. So this is 2018, I think 2021, if I'm not mistaken, it's supposed to go away. So. The mortgage interest, a big change there. Prior years, you could deduct mortgage interest up to $1 million, and then after that, there was a formula to kind of figure out how much you could deduct. That's been changed to $750,000. So, and that's on new debt acquired after December 15th of 2017. One change as well that the TCJA made was the deduction for home equity interest. In prior years, you could take out a home equity line or a HELOC and send one of your kids to college or buy a new automobile or whatever, and then deduct it as mortgage interest. Well, in 2018, you can't do that anymore. That home equity line has to be used to improve your residence or your secondary home. So. Big change there. Charitable contributions in 2017, they were limited to 50% of your adjusted gross income. In 2018, it jumps up to 60% of your AGI. And speaking of charitable contributions, another quick planning tip: if because the standard deduction has been raised, for an example, married filing joint now, the standard deduction is $24,000. Well, if you're making contributions to a charitable organization and you're still not going to be able to itemize, and if you're at age 70 and a half, where you have to take required minimum distributions from a qualified plan, an IRA, then what you might want to consider is do what's called a qualified charitable distribution. The money comes from that IRA. It doesn't go to you, but it goes directly to that charitable organization. So, and you can really reap the benefits there, because let's say you can't itemize and you want to make a $10,000, charitable donation to a qualified charity. Well, if you take it from your IRA, and you can only do it if you're required to take those RMDs, so age 70 and a half, and I think you can go up to 100,000 if I'm not mistaken. So, and it also counts for your required minimum distribution, but you can take, say, 10,000, you wouldn't get any deduction for it as an itemized deduction. But if you were, say, in a 22% tax bracket, it just saved you $2,200 in tax. So, because if you would have took that, got it yourself, gave it to the charity, you really wouldn't get any deduction from a tax standpoint. So if you did what's called a QCD, then you would get you wouldn't get to deduct it. You don't have to claim it as income. So it would save you as far as taxes go. Personal casualty losses no longer deductible. Prior to 2018, if you suffered a casualty, say your home, and was not reimbursed by insurance, then you could deduct it. Of course, it was limited to 10% of your adjusted gross income. But the new rule is it has to be a federally declared disaster area before it's even deductible, and then it's not subject to the 10% limitation. That's in 2018 and on. And that's only personal casualty losses. Business casualty losses are still deductible. Wagering losses, you can now, it's been changed where you can deduct expenses, for an example, travel expenses, from your home to the casino and stuff. And when it comes to gambling losses, they're only deductible as an itemized deduction on Schedule A. So if you had 10,000 of winnings and say 10,000 of losses, but still couldn't itemize, well, you've got 10,000 of income and stuff. So a big change as far as the 2% itemized deduction limitation on Schedule A. Those are pretty much gone, which that included unreimbursed employee expenses, for an example, mileage and things like that employees did not get reimbursed for, union dues, tax preparation fees that are deductible on Schedule A, as well as broker fees. Those are no longer deductible. Up to 2017, depending on your income, your itemized deductions could be phased out under what was called a P's limitation after the genius that came up with it. But it could be limited. So those are gone now. Your itemized deductions will no longer be limited. If you have children at home under the age of 17, a big change there. Of course, we lost the exemption, the personal exemption for yourself, your spouse, as well as the kids. But the major change there was the child tax credit went from $1,000 to $2,000 per child, and had to be under age 17 as well. But look at the phase outs where it used to start phasing out at 110,000. It now phases out at for a married filing joint at 400,000. So a real big change there. And then also the child tax credit can be refundable up to $1,400 per child. And what that means is if you do not have a tax liability, and then there's a couple other qualifications, but up to $1,400 of that $2,000 could be a refundable credit, meaning you get that money back. So. This is also new. It's a tax credit for non-child dependents. For an example, you've got an 18-year-old or a 19-year-old that's away at school, will not qualify for the child tax credit, but they will qualify for the non-child or non-dependent or the tax credit for non-child dependents. So, which is only $500, but still, that again is a credit. It's not a deduction; it's a credit. So it reduces your liability by that $500. And on the child tax credit, if your child turns 17 on December 31st, how much of that $2,000 credit do you get? Zero, right? You don't get any of it. You lose it for the whole year. Just like if you have a child born on December 31st that qualifies for the child tax credit, you get it for the whole year. So. Some big changes in the alternative minimum tax. Some of you may be familiar with that, but that came out years ago to sort of close some loopholes and sort of make sure, kind of even the playing field and make sure everybody paid a little bit of tax. And if you got hit with that, you probably paid a flat rate of 26 or 28, but you can see the change there as far as the exemption. For an example, for a married filing joint, it jumps up to 109, almost 110,000, but the phase out as far as losing that exemption is at about $1 million. So some big changes there. The Affordable Care Act, the ACA individual responsibility payment, 2017, 2018, it could be as high as 2.5% of your household income or $695 per person. I think a child is about half that, if I'm not mistaken. But then in 2019, it's repealed. So, meaning if you don't have health insurance, you won't get penalized anymore. Let's take a look at a couple examples real quick, and hopefully this will kind of shed some light on the changes in the tax brackets. And again, these are just examples. I mean, you'll have to kind of take a look at it, from your own tax situation. But and one thing I missed and wanted to point out on the tax brackets, and it has to do with what's called a marginal tax bracket. And if you flip back to one of those front pages, for an example, a single, say the 24% for a single tax filer starts at $82,000 and goes up to about $157,500. So if that taxpayer is in that taxable income range, then that's the marginal tax rate. So if he or she was expecting a bigger jump in income, then hey, what is it going to cost me? So that's the marginal rate, and it would be at 22 or 24% would be the marginal tax rate. So, and then if you're toward the end of that bracket, then if you get a big jump in income, then it's probably going to knock you into the next bracket. So just keeping those in mind, if you get a big bonus or a spike in income, then you can kind of look at those brackets to see where you're at and then what that additional income will do from a tax standpoint. The first example, we've got a single taxpayer, $50,000 of wages. We're assuming no dependents and taking the standard deduction, which for a single filer for 2018 is $12,000. You can see what the tax rate was, or the tax liability in 2017 was. The effective rate was 13.8%. 2018, the liability drops to about $4,370. The decrease is a little over $1,000, so about a 2.3% decrease. The second example, same single taxpayer, same assumptions, no dependents, $100,000 in wages. You can see what the liability is. It drops by about $2,700, and the savings there is about 2.8%. Same single taxpayer, $150,000 in wages, same assumptions. And you can see that the decrease in tax is about $4,600. Moving to a married filing joint, $50,000 of wages, taking the standard deduction, 2 child tax credits. The liability in 2017 was about $236. In 2018, it goes, they're probably getting some of the refundable child tax credit, but it drops about $1,497. So same assumptions, 100,000 of wages, married filing joint. 2017 liability is about $7,700. 2018 it drops to about $47. So the decrease is almost $3,000, or about 4.7%. Number 6, 150,000 of wages, almost $22,000 liability in 2017. Effective rate's about 18%. In 2018, there's a savings there of about $6,100, or 5.6%, and assuming 2 child tax credits and the standard deduction. And again, we've lost the exemption, so that $4,000 exemption that we had for taxpayer, the spouse, and the children, that's gone. So. Okay, a change as far as the Kiddie tax, and some of you with kids that had unearned income may be familiar with this, but it's now going to be taxed. In 2017, it was based on the parent's marginal tax rate as far as the unearned income, but in 2018, it's going to be based on the trust and the estate tax rates, which those rates are considerably lower. Those brackets are considerably lower than the individual rates. But no longer will it be tied to the income of the parents and stuff. So, well, I say that right now for 2018 up through, 2025, I think. Most of these changes are good through, 2025? So, we hope. Yeah. Maybe gone next year. not really changed by the TCJA, the Tax Cut Jobs Act, but you can see the real increase there, significant increase in the taxable Social Security wage base from 2018 to 2019. So about a $4,500 jump from 18 to 2019. And then, of course, there's no limit on the Medicare tax. A major change to 1031 exchanges, or we refer to them as like-kind exchanges. Prior to and up to through 2017, it applied to not only real estate but also other assets, business assets that you traded in, and then you could defer paying tax on any gain and stuff. Well, that starting in 2018, it only applies to real estate. Net operating losses in 2017, you had the option if your business took a operating loss in a taxable year, then they had the option of carrying that loss back 2 years. If there was taxable income in that second prior year, then it could generate a refund. Or you had the option of carrying that NOL forward, that operating loss forward. Well, in 2018, the first change is that loss that you carried forward is only it's going to be limited to 80% of the taxable income for that year, and then also you can't carry it back anymore. You only can carry it forward. So there was a change as well. If you have a excess business loss, which for married filing joint is $500,000, for single and other taxpayers it's $250,000. But if it exceeds that amount, you can only use $500,000. Anything in addition to that would be carried over. And what I mean by that is, let's say you're in a partnership or an LLC, and you can actually deduct the loss. We won't get into being able to deduct them or not, but let's say you can deduct it. You meet the qualifications to deduct it, and let's say it's a $600,000 loss that's flowing through. Well, you've got other ordinary income as far as wages and other things that's over that amount, say $800,000. Then you're only going to be able to use $500 of that loss. The other $100,000 would carry forward to future years. You wouldn't lose it, but it will carry forward. And those are carried forward now indefinitely. I think they used to be, 20 years? And now they're carried forward indefinitely. Well, we all know from a tax standpoint, nothing is definite, right? Or indefinite. I don't even guess it's definite, is it? Some major changes as far as deducting your expenses when it comes to equipment, as far as under what's called Section 179, and then also we'll look at another term under Section 168. But a few years ago there were some changes made as far as being able to deduct equipment, and it was under the capitalization rules, where if that piece of equipment was less than $2,500, then you did not have to capitalize it and take depreciation on it. For an example, if you had a business, bought a new computer, that computer was $2,000, then you could expense it and not capitalize it and take depreciation on it. You could actually take the expense as office expense or office supplies or something like that. So, and that's up to about $2,500 if you don't have an audited financial statement. If the business has an audited financial statement, then I think it jumps to, is it $5,000? I think it's $5,000. So Tom gave me a thumbs up, so $5,000. Again, if it's below that amount, $2,500, without an audited financial statement, then you can just put it in supplies, office expense, or something like that. If you've got a rental home and you have to buy a new appliance, say a new fridge or something, it costs you $1,500. Well, instead of capitalizing it under the old rules, you can now just put it into supplies and actually get the benefit all in that year. So, but under Section 179, the old rule, and this is where you can more or less, if you buy a piece of equipment, say you're in a construction business and buy a new Bobcat and it's $30,000. Well, what this allows you to do is take all that expense, if you need to, in that current year and stuff. So, once we talk about Section 179 and the next one, which is, we call it the bonus depreciation, it actually gives you as a taxpayer and us as your CPA or an accountant a lot of leadway as far as, some really good tax planning, where if you're not going to need the deduction this year, or if you really need it, we can really, especially when it comes to the Section 179, we can really really do some things that, can save you some tax dollars or at least defer you some tax dollars. So. But in 2018, the Section 179, as far as being able to write off, you can actually write off up to $1 million of equipment that you purchase in your business. Now, of course, if you purchase that much, then it's going to be limited. If you've got taxable income, that kind of stuff, you won't lose the deduction. It will still carry forward, but there are some limitations there as well. And it phases out at 2.5 million. So once you get at 2.5 million, then it reduces dollar for dollar. Still under Section 179, there are some, as far as qualified real property, some changes like air conditioning units for non-commercial build or for commercial non-residential real property that we can actually use Section 179 now and get that deduction on the current year. Also roofs. And there's been a lot of, I think, controversy in years past as far as, being able to deduct those under Section 179 or not. So actually clarified it, I think, in this act. This is the other tool that we have, and you have as a business owner, and it's called the bonus depreciation. It's under Section 168, also known as SDA, Special Depreciation Allowance. In 2017, actually September 27, 2017, it was changed where you can actually take 100% write-off, and this is sort of different from the Section 179, but you can actually under this rule, you can still write off that piece of equipment, and there's no limitation. So if you have 2,000, then you can write off 2,000, or 2 million, you can write off 2 million. Where Section 179, you were limited to 1 million. So. But it kind of phases down as we go. 2023, it drops to 80%, and then 60% in 24, and then in 2027, it's scheduled to go to 0. But this has been around for a while. When it first came out back in, I think, early 2000s, it was about 30%, if I'm not mistaken. It kind of stayed there. It may have went away for a year or two, came back at 50%. It's been up to 100%. It dropped down, and this is what it is. So it's been around for a good while. Also, a big change as well was the prior requirement to be able to expense something under this rule. It had to be new equipment. For an example, again, using the Bobcat, it had to be a new Bobcat. If I bought a used Bobcat from Steve, then I could not use this rule to take that 100% deduction. So, but under the new rules, it can be new or used. A change as far as what's considered qualified improvement property. Any improvement to an interior portion of the building that is non-residential real property, if such improvement is placed in service after the date the building was first placed in service. It does not include any improvement for which the expenditure is attributable to the enlargement of the building. Can't expand it. Doesn't cover elevators, escalators, or the internal structural framework of the building. And this new definition kind of rolled up. If you look at the bottom of that slide, it kind of replaced the definition for qualified leasehold improvement, qualified restaurant property, and qualified retail improvement property. Vehicle depreciation, and this is pretty much for like a luxury type auto. You can see what it is there for 2018. It wouldn't qualify for, well, up to a certain limit, you might get Section 179, but if you didn't take the special depreciation on it, then that's what it is for year 1, 10,000, year 2, 16, and then after year 3, it drops down to 5760. Some big changes as far as deducting entertainment expenses, and this applies to businesses. But in 2017, entertainment expenses were deductible at 50% if they were qualified entertainment expenses. But in 2018, there's no deduction for them. So what that means is if I take a potential client to, say, a Titans game or something like that, and the tickets cost me $200, then if I can't deduct that expense as a business deduction, so not even at 50%, no longer deductible. change as far as the 529 education plan. You can now use up to $10,000 per student, and this is annual. You can use that for public, private, religious, elementary, or secondary schools. So big change there. You can see the estate and gift tax exemptions for 2018, almost doubled, about 11 million per person. Okay, here's one of the big changes in the new tax law, the TCJA, and I've got a lot of information on it. Some of it I might kind of blow through pretty quick. Just want to give you a quick down and dirty, and then we've got some examples that we'll kind of look at, but this is one of the major changes, and it impacts businesses, and basically it could give you up to 20% of your qualified business income, certain limitations as far as the deduction. So again, one of the big changes. And we've been spending a lot of time throughout the year. This came out in December, doing a lot of research and reading and things like that to kind of get a really good grasp on it to see how we could use it to help you as business owners save money when it comes to taxes. So let me go back to that one. Again, it's the pass-through entity. That's the code section there. It's a deduction equal to 20% of the qualified business income, and it's from flow-through businesses such as a partnership, S Corp, LLC, and also sole proprietor. So a C corporation, this would not apply to a C corporation. And one of the reasons I think this was brought in is because as we get toward the end, you'll see that the tax rate for a C corporation has been dropped down to a flat rate of 21%. So I think this was brought in to kind of level the field for S corporations, LLCs, and sole proprietors. So the income must be from a trade or business within the United States. The investment income does not qualify. Amounts received from the S corporation as reasonable compensation or from a partnership as far as guaranteed payments would not qualify. The 20% deduction is not used in computing adjusted gross income, so it would be taxable income and then the business deduction. This deduction also, if your income is subject to self-employment tax, it would not reduce the self-employment tax as well. The deduction is phased out ratably for individuals with taxable income 157 to 500 to 207 500. That's a single, and then married filing joint 315 to 415. And then there's another limitation that comes into play where you can still take that business deduction, but you have to be paying wages or you have to have capital equipment inside the business that will help you take that. We'll look at that in a little bit. Also, along with this, it sort of disqualifies a few businesses from taking this, and it's the income from the following trades or businesses, and I don't think this is a complete list, but they're called specified service trades or businesses, SSTBs. Sounds like something else, doesn't it? But anyway, specified service trade or business deals with health, doctors, lawyers, consulting, accountants, athletics, financial brokerage services, and then the last one there where the principal asset is the reputation or skill of one or more employees or the owners. For an example, Tiger Woods, all the endorsements that he gets for, whatever, what's he wear, Nike? Is it Nike? That would not qualify for the business deduction, so. The allowance for the deduction, it's a combined qualified business income, 20% of that or the taxable income. However, when you get to taxable income, if you had long-term or capital gains, you would have to take that out of the taxable income. I think we've got an example for that as well. Combined qualified business income, it's the sum of the deductible amounts for each qualified trade or business. So if you have one or two, three businesses, each one of those, you look at each one of those. We'll look at some aggregation rules a little bit later on. And it's 20% of the aggregate amount of the qualified RET, the REIT dividends, as well as the income from publicly traded partnerships. We'll look at the 50% wage limitation. And also, I've got a flow chart. We're going to look at the flow chart because I think that will kind of help answer some questions and stuff as well, as far as being able to apply these rules. And I don't want to bore you with a bunch of the calculations and stuff. When we talk about qualified property, it's a tangible property of a character subject to the allowance for depreciation. The depreciable period, if you look toward the bottom there, it begins the date the property was first placed in service, and it ends the later of the date that is 10 years from the beginning date or the last day of the last day of the last full year in the appreciable recovery period that would apply to that property. So, for example, if you had a piece of property that was 5-year property and you're in year 6, you still get to take that up until year 10. So, again, there's the modification to the limit based on taxable income, $157,500 for a single taxpayer, $315, and then there's a phase in and a phase out. If you add $50,000 to the $157, $207, and then $100,000 for a married filing joint to the $315. Okay, there's the definition of qualified business income. It does not include short-term capital gain, short-term capital losses, long-term capital gains, those kind of things. Also, reasonable compensation and guaranteed payments, that is not included. And as far as carryover of losses, if you look at the bottom of that slide, in 2018, a taxpayer has a net qualified loss of $50,000 from a qualified trade or business. In 2019, the taxpayer has qualified income of $40,000 from a qualified trade or business. Then the net there is a $10,000 loss from qualified trade or business income that will be carried over to 2020. So if you have a loss, then that loss is going to carry over, and then if you have income the next year, well, it's going to offset that income. So you can't just do away with the loss and then the next year have $100,000 of income and not reduce that amount. There are some aggregation rules. I think there's a couple slides there as far as aggregation, and I want to say the big rule there is they have to be similar in trades or businesses. So, for example, you can't aggregate like a construction business with like a restaurant business. So, but if you had a restaurant, say a restaurant, and then a food truck, then you could probably aggregate those. And one reason, we sort of looked at why you wouldn't want to if you could, and we can't really come up with a good reason why you wouldn't want to, because, for example, one of those businesses may have wages, the other one may not have wages, but it has income. You could, get a bigger deduction and stuff, so. That's the big rule there that we just talked about as far as being similar businesses. Here's a flow chart here, and I'll tell you what we're going to do. We're going to look at the first example, and then we'll look at the flow chart. Example 1, a married taxpayer, taxable income of $500,000, including income of $300,000 from a specified trade or business. And keep in mind, once you get past those thresholds, then, if it's a SSTB, then they would not qualify for the 20% deduction. So the result here is no deduction. Income is from a specified service business, and taxable income exceeds the upper level of that threshold, which for married filing joint is $415,000. I think this was in your packet, if I'm not mistaken. Let me see if I can find it on here. Okay, there we go. Now, I don't know if you can see that. Is that hard to see? But you've got it on your table as well. So again, to get this deduction, it has to be a sole proprietorship, S corporation, partnership, or an LLC. If you go to the right there, yes, meet that qualification. Keep going. Does the taxpayer have taxable income tax at ordinary income rates? Drop down, yes, and then go back to your left. Is the entity for which the deduction is being claimed a specified trade or business? Yes. Then we're looking at the thresholds. There's the first threshold as far as the lower limit of it. And then it goes on. In this case, it would be no, because it's over that amount. Is the taxable income of the taxpayer less than $415? No, because it was what, $500,000, I think, taxable income. So there would be no deduction in this case as far as the qualified business deduction. Let's look at, there's several examples here. We'll look at one more. I think it's example 2. Okay, here we go. Married taxpayer, taxable income of $385. So automatically, we're within that phase-out range, $315 to $415, including income of $300,000 from a specified service business, and then the taxpayer is paying wages in the business. The W-2 wages are $150,000. Before, and the result is they get a deduction of $18,000. Before we look at that, let's take a look at the flow chart, starting with as far as being a sole proprietor or an S corp. Yes. Does the taxpayer have taxable income, tax ordinary income rates? That would be yes. Moving back to the left, still would be yes. And then coming on down to the second, the upper limits of the threshold, is the taxable income of the taxpayer less than $415,000 if married, filing joint, or 207, and the taxable income is $385. So we would meet that. We'd go down to yes, and then we would receive a partial deduction. So, and then the calculation for that is, I think you've got that in there as well, but there's a calculation to, because we're in the threshold there, we take the $385,000, which is the taxable income, and then the limit there, the lower limit, $315,000, divide that by $100,000, it comes out to 30%. So our qualified business income is $90,000, $300,000 times that 30% limitation. The share of the W-2 wages is $45,000. If you take 150 times 30, that's $45,000, and then so it's the lesser of 20% of that $90,000, which is $18,000, or 50% of the wages, which is $22,500. So we get some of that deduction there, $18,000. We won't go through the rest of these examples. You've got the slides there as well as the flow chart. Let's take a look at the corporate tax rates. In 2017, you can see what the corporate rates were. They started at a 15% rate up to $50,000, and then actually went all the way up to 39, and then dropped back down to 35. But in 2018, those rates have been reduced to 21%, just a flat rate, and it says permanent. So. Cash method of accounting, in 2017 up to $5 million gross receipts. In 2018, that has been raised to $25 million. Dividends received deduction. This applies to corporations. 2017, you could receive an 80% deduction if it was 20% owned, or 70%. In 2018, it drops down to 65% and 50%. The good old alt-min tax for corporations, even though it was not repealed for individuals, for the corporations, it goes away in 2018. So, and then if you had paid AMT at the corporate level, then that can be refundable in future years, I think up until 2022. Okay, any questions?
Capital gains, like on the sale of a home or something like that.
Yes, correct. Married filing joint, and his question was, on the sale of a personal residence, is that taxable? Well, for married filing joint, if you meet the, it's section 121, if you meet the rules, I think live in that as your primary home for 2 years, then if you sell that home and have less than a $500,000 gain, then that is not includable as far as income. So, and then married filing separate, I think it's $250, or single or whatever is $250. So. Mm-hmm. Any other questions? Yes, sir. Are you renting the home? It's, have you ever lived in the home? Because the look back period is 5 years. If you lived in that home 2 out of the last 5 years as your personal residence, you could still exclude it.
This is second home.
Second home? A family member probably lives in it? No? Doesn't matter. But if you did sell it, if you didn't live in it, then yes, it would be taxable. If you've never taken depreciation on it, then it's probably going to be, how long have you owned it? More than a year?
Yeah.
Then it would be long-term. Long-term capital rates, depending on your tax situation, could be 0%, could be 50, and it could go up to 23.8. So it just depends on where you're at from a tax situation.
We live two different places. Florida part of the town, Tennessee part of the town.
Okay.
What does that count?
Where do you get your mail?
Huh?
Where do you get your mail? Where do you vote? So that would those are some of the facts that the IRS would use to consider, your primary residence. So, yeah. And how long are you here versus Florida?
Just whenever.
We try 50-50.
50-50?
Last year we've been more here than there.
Your driver's license still Tennessee, or it just, again, it would be based on the facts and stuff. So.
Is there a change to charitable contributions in regard to religion? Sorry.
The 50% limitation, the 60% limitation, as far as your adjusted gross income, that's the only change that I know of, correct?
Right.
Yes, sir.
Second, he's coming. Right there.
Under the under the state and local taxes, is that just under your personal property, or does that include businesses as well?
No, very good point.
We have one piece of property that county taxes more than that.
Is it you? But you deducted. Are you renting that property? Is it a rental property?
We own it.
Yeah, but are you living there? Is it a business property? It is a business property. Okay, very good point. What I referred to when I gave you the $10,000 limit as far as taxes applied to Schedule A itemized deduction, which included state income taxes paid, sales tax, as well as your property taxes. Well, that does not apply. That limit does not apply if you've got a rental property. Those taxes are still deductible on Schedule E, though, not on Schedule A as an itemized deduction. So, and that $10,000 limit would not apply to that. Still deductible. Yeah. Very good point.
Could you tell me about something called ABLE account or American Opportunity Tax Credit?
The American Opportunity Tax Credit is it's a credit for someone that you're claiming as dependent for school, and it's up to what, $2,500, I think, is what it is. So, but to get the American Opportunity Tax Credit, you have to have them claim. You have to claim them as a dependent. Now, again, we don't have the exemptions anymore; they're gone. As far as being, you claim an exemption or dependent on your tax return, you got the $4,000 exemption, child tax credit, and those kind of things. Well, those rules to determine whether you can still claim someone as an exemption or a dependent for the child tax credit, the earned income credit, and dependent, those things, they're still in place, and they still apply. We just don't get the exemption form anymore. So it would still apply as far as the American Opportunity. The parents problem, they could get that and stuff. So, and I want to say they can get it even though you pay the expense. Able. Somebody help me out on that. Able. Tyrell?
It's for disabled individuals that are under the age of 26. The tax advantages are that you could set that up for them as a savings account to use for their disability expenses.
But is it for education or for?
An ABLE account is for disability.
Okay. That answer your question, Mr. Taylor? Okay.
I don't believe there's any credit or deduction for your contribution to it. I believe it's just a savings account that would be, it can grow tax-free.
Yeah. Sort of like I guess a 529 plan where you put money in the 529. You don't get a deduction for it, but it grows tax-free if it's used for education. So.
David.
For this section 199, if you have an LLC or a partnership that's a real estate holding company, meaning that it's not a true business in the sense of a word, it's investment income from real estate. Does that qualify as a business income or does it not?
We have really looked at, does a rental property qualify for the qualified business deduction, section 199A? We're taking the position because the things that we've read, the seminars that we've attended, have alluded to, if that is treated as a trade or a business, and if you are materially participating in that trade, in that activity, then we are probably going to lean toward that qualifying for that business deduction. There's a lot of stuff out there, a lot of information out there. And again, the seminars that we went to, the things that we've read have sort of alluded to that, yes, it would qualify.
But you need to file 1099s.
That would
we
really
would encourage that.
Filing a 1099 for someone that came in and did work under the rules for a trade or business, yes, you should be filing 1099s for those, and that would help in your favor as far as, yes, that is a qualified trade or business. So good question. Yes, sir.
We talked about RMDs going to charity and not being as income. Does that only apply to IRAs, but not to any other?
Well, it has to be a qualified account, if I'm not mistaken, and it has to. You have to be. You have to take an RMD from that account. So you have to be 70 and a half. You can take up to 100,000, and it also counts for your RMD. And you can't get it and then give it to the charity. It has to go to the charity. So I think it can be made out to the charity, and if you get it and give it to them, then I think that will work. But you can't get it, and then cash it and then take it to the charity. So.
But we could do that also from a 401k or anything that's a qualified.
A qualified account, correct.
Okay.
Yep.
All right.
If you're required to take an RMD from that account, because when it comes to RMDs, you have to look under the regs. You look at each account to determine how much you're supposed to take. Well, if you have an account A over here that is where you want to take it all, you can actually take it all from A. You don't have to take some from A, B, C. You have to look at them, calculate the amount for each one, but then you can take that distribution from one account. So, am I incorrect in that? I am right. Okay.
I don't think you can do it from a 401k. I think it has to be an IRA.
Is that correct, Steve? Tom says yes. So IRA. Backpedaling. IRA. Should start karaoke in here and stuff. But IRA. A 401k would not. So even though you have to take an RMD from that. I'll tell you what, I'll double check. Yeah, I'll double check, but just to make sure. Oh, you just Google it. That's how we do all our research, Google. No, just kid. Yeah. So that should be correct then, Mr. Taylor. Any other questions? Y'all ready for some karaoke then? Just kidding. Very good point. Very good point. You could roll it into an IRA, the 401k, roll it into an IRA, then it would qualify. So, tax planning tip. No charge on that, Mr. Taylor. Any other questions? hopefully you've gained some knowledge as far as the tax rules and how they may impact you or a family member. And again, if you picked up something that can save you some money or even defer tax, I mean, even deferring tax to the next year or 2 years down the road, is we always look at that as a good thing. So really appreciate it. And again, thanks for the good support and the turnout.
Well, thank you, Mike Henley. I think he did a great job in giving us support. A lot of great information. And again, if you have questions, after you think through and process all this information, just give us a call and we'll be glad to answer any further questions. Don't forget to fill this form out, leave it on the desk there as you're leaving. Also, I wanted to tell you about two quick things and then we'll let you go. We have just recently launched a speakers bureau. So if you are part of a civic organization, a community organization, and y'all need a speaker, we have several people on our staff. Those of you that are on our speakers bureau, if you would stand up and wave your hand so people can see who you are. So we have several, I think there's 8 of us on staff that is available for a speaker for an organization on any of our tax, accounting, tech, all kinds of different topics. So just contact us if you need that. Also, we're on social media. We're constantly putting out tax tips and new information out there. So please go like us on Facebook, Instagram, LinkedIn, and check our website weekly for our blog on our updated tax tips there. So other than that, thank you for coming. We appreciate it. Happy holidays.